Welcome back to Making Money Matter, ladies and gentlemen. I'm your host, Kerry Stevenson, and I've asked Alexander Scanlon. He's the founder, the managing director, and the CEO of Barton Gold. The ASX code is BGD. Alex knows sometimes I get that confused, but it's BGD is the ASX code. Now, as background, I said that Alex was the founder, the CEO, and the managing director, but I think it's also important to note that Alex has an economic background. He's a financial economist, which means, ladies and gentlemen, he's good at numbers and making sure that shareholder value is realized over time. They have a couple of projects down in South Australia, the Tarcoola and the Tunkillia project, which we're going to cover today, along with a lot of work they've been doing in 2023 and what's to come in 2024. Alex, great to see you. Thanks for joining me. First time that you and I have been together on Making Money Matter, so welcome.
Thank you for having me.
Last time I saw you was at the Australian Gold Conference. We'll be doing it again in August this year, but this is a really interesting gold story. And I'm talking to you at a great period of time because the gold price is waking up and starting to look really interesting. But before we
you did a good job of getting that alive for this conversation. So well done.
Yeah, no problem. No problem. I just talk to the right people. Alex, give our beautiful community out there a brief background of who are Barton Gold, and then we'll get into some detail.
Yeah, so the very high level summary is we are a pure play gold, pure play South Australian developer. In the Central Gawler Craton of South Australia, there is a 130-year-old gold district with a history of high grade production. And this is actually right next door to the iron oxide copper gold district. So the one where BHP has Olympic Dam and now Carrapateena and Prominent Hill. So parallel gold district. We've essentially consolidated every significant historical exploration and producing asset. This includes historical producing mines, the largest undeveloped gold-only resource in South Australia. And the strategy for us, we also acquired the only mill. The strategy for us is to build up a multi-million ounce resource base and bring this back into staged development operations at a much larger scale basis, targeting about 150,000 ounces per annum. And to do that in a staged basis using our existing infrastructure for lower cost, lower risk, and lower dilution advancement through a nice development curve.
When you say lower dilution advancement, what do you mean by that? I mean, by that, you're talking about the dilution of the shareholder value over time.
Correct, right. So in very simple terms, if we are able to leverage existing infrastructure, then we are able to take a step to transition from a pre-operator into an operator status with a much lower cost. And that means, if we're thinking about it, it's the simple, the cost of buying a mill. We would need to raise far less money or spend far less money to recommission an existing plant than to build an entirely new one. We had our mill valued at around $150 million in replacement costs earlier this year. So, if you're spending $10 or $15 million in recommissioning and a bit of working capital to get going, that is literally 10% of the sort of cost of building a new mill. But you're also, because we have fully permitted mining leases and a fully licensed mill, we're 2 to 3 years ahead in terms of time. And that time is what's critically valuable. So that's also time we're not sort of sitting, spending money, doing nothing, or not actually starting to operate.
Do you think that makes you a little bit different? You just said you've got the mining permits all in place and you're 2 to 3 years in advance. Talk to us about where that is, why you are that 2 to 3 years in advance against other projects that are out there.
Well, in really simple terms, if you just think about, one, there's the work that needs to be done to demonstrate that you have a viable asset, right? But once you then do that work, if you were to say today, hey, look, we want to push go and we are going to develop this asset, you then have a 2 to 3 year process between stakeholder consultation, environmental approvals, mining license applications and submissions and all of these things. You typically would have a 2 to 3 year process to get a mining license and an operating license in place. We already have that. So for us, we're kind of more in a position of saying, we have this platform, which all we need to do now is focus on backfilling the material that we want to put through that first. And that makes us rather unique. It means we're walking up to the decision line with the ability to essentially operate from the next day or to start recommissioning the next day, as opposed to saying we're targeting 3 years from now.
Yeah, and when you start to say that, obviously, as if you get into production, because I look at you more as a development story, not an exploration story, although you are still doing exploration. But in saying that, once you get into production, that's when the cash flow begins.
Well, that's right. Yeah, I mean, and and that is the benefit of the existing infrastructure. If we can leverage that, not only does it cost less in terms of whatever equity component you might need to contribute to its construction, but when you're actually in production, when you're generating ounces, when you're generating profits, um, if you're not paying a bank back $100 million for that mill over the course of 5 to 6 years, that is all additional free cash that we can reinvest into expansion. And because that is where you then get to the true sort of middle distance, large production objective, and the returns to equity there in terms of shareholder valuation are non-linear. Moving from say 50 to 150,000 ounces is traditionally not assume all else equal, it's not a 3 times valuation increase to reflect a 3 times production increase. It's often more like sort of 5 to 10 times valuation increase. So we want to make sure that we're essentially using the starting stone or as a stepping stone or a ladder to that bigger picture objective. So if we're generating profits and we get to keep the vast majority of the gross profits, then we can invest that very efficiently forward into that growth.
Okay, so I said at the start that you've got a couple of projects. A lot of people that would know about gold, and some of you out there, some of my beautiful community out there, you're scratching your heads going, well, I'm sort of new to this game. So let me just explain that a lot of people look at Western Australia as being the gold district. You're in South Australia. A lot of people go, oh, South Australia, that's interesting. But this is an area that you feel very confident in. The Tunkillia project, I think you acquired that from memory in 2019.
Yeah, just at the end of 2019, the beginning of 2020 is when we took control of that.
Then we had COVID. Talk to us about what you've done between the acquisition and how you've created shareholder value as I speak to you in December 23.
Yeah, so with Tunkillia in particular, we acquired that as a 558,000 ounce asset at the beginning of 2020. We, with nothing else to do, in locked in boxes, we did a lot of work throughout 2020. We actually upgraded that to a 965,000 ounce resource during October 2020. And I have to say, we were fortunate as a company. We were able to travel much better than many other people were able to cross borders. We had exemptions around some of the work that we were doing regionally in South Australia. So we grew that. And then we were really leaning into doing a lot of sort of R&D driven theoretical work around structures and geophysical signatures. And we drilled and tested multiple targets that we thought around the original deposit could have new gold zones. We identified 3 new satellite zones, so demonstrated the footprint grows. And then across the balance of the beginning of 2023 and through the end now, we've had 2 very aggressive drilling programs, which in total were probably close to 50,000 meters drilled since September of 2022, so across 15 months. And the result there is that we grew it from 558,000 ounces to 965. And then this year, in calendar year 2023, we've actually grown it twice. So we added 189,000 ounces in April, and we added another 224,000 ounces this week on the 11th of December. And the sort of the cumulative benefit for us in doing that is, one, the scale, the growth there was quite significant. That's about a 40% increase in that resource, but we did it also very efficiently. So with the kind of very careful thinking and planning and strategizing we were doing, been very efficient in where we are aiming, so to speak, and we've had a very high hit rate. And we have added during 2023 413,000 ounces of gold at an all-in cost, so truly inclusive of drilling and assaying and field and logistics and all of that kind of stuff. An all-in cost of $14 Australian per ounce, which is really bottom of even the global cost curve in terms of discovery cost.
So that's for people that don't know, the average cost would be about what, Alex?
So there's a couple of really good papers written throughout 2015, 17, 19 that sort of occasionally benchmark this, but in the Australian context, the average ounce of finding, or sorry, the average cost per ounce of gold, adjusting for some fairly minor inflation, which we know has been major, but you'd probably be looking around 80 Australian dollars
Oh,
per ounce.
wow.
So this is kind of, this is on the order of about 20% of the average discovery cost per ounce in Australia.
How have you done that? Because
Uh,
that's 14 to 80. I mean, even if you said 14 to 50, I'd be like, really?
Yeah, so look, it's, I mean, a lot of thinking is the answer, right? So we've looked at a lot of historical data. We've taken we've collected a lot of new data using either tools that haven't been trialed in the area before, or said something. A lot of what we do is actually trialing new technologies and tools to see if they can give us different ways to, mix 5 or 6 things together and see if we can predict something. But also, we could take existing historical data sets and apply much greater processing power now than existed 30 years ago when they were originally collected. So some of our work at Tunkillia, a lot of our work is actually guided by a new geophysical model that we put together. And that was basically looking at a combination of essentially magnetic signature, or the lack thereof, where, in areas where sort of fluid movement, we think, destroyed magnetite in the ground, but then also a specific part of the sort of the relationship with that and increased resistivity. So areas where there's a higher silica content that resists electrical signals. And we think that there is a sort of bandwidth of that relationship, which indicates indicates ground amenable to hosting specifically the style of mineralization that we've typically seen at Tunkillia. And each of the 3 new gold zones that we predicted and drilled very accurately, not only in terms of their existence, but their exact orientation, each of those 3 new gold zones around the main deposit, the 2 recent extensions of that deposit are actually offset, so they're not linear extensions. And this southeast offset target that we've drilled, which is, we think, a very exciting target, all of those have been correctly predicted. Well, southeast offset is to be determined. If that comes back mineralized, it'd be very exciting. But essentially, right now, we're sort of 5 for 5 predicting where to aim. And so that has allowed us to be very efficient with the money we're putting into generating and then validating these targets.
Drilling can get expensive. Deeper you go, the higher the cost, Alex. How deep have you gone? Like, I'm trying to get a visual of, and allow our audience to get a visual of what this looks like. Is it going to be open pittable? And by the way, ladies and gentlemen, when it's open pittable, it means that it's close to surface. It's a little bit cheaper to do open pittable as well. But what's your view on it? How deep have you gone? And what's the grade looking like?
Yeah, so to start literally sort of from the surface down, we prefer open pittable mineralization. That's kind of our thesis and what we're looking for sort of large production. The more you can operate in bulk, the more efficiently you can operate. And obviously, there are limitations to what you can do in an underground environment because you have quite literally a hole that is only so big. And to use the kind of silly analogy of, sucking golf balls through a garden hose, you can only have so many vehicles going up and down a mine decline at the same time, and you have to juggle very carefully. An open pit, if you have big, broad mineralization in a wide open pit, firstly, it's easier, faster, cheaper, and safer to explore for, develop, and operate. But 2, you have essentially, you have much wider margins for error without major consequence, right? So if you have an underground narrow grade mine that has 2 meters or 3 meters of very high grade mineralization, but you take an extra meter of material, that's 35% dilution to that 3 meters. If you have an 80-meter wide body of mineralization in a big open pit, and you suddenly get an extra meter of mineralization, you're looking at sort of 1.2% dilution. So the margin for error is a lot smaller, and the consequence of that error is a lot smaller. So we favor open pit. We have only modeled resources down to 300 meters depth in the main Tunkillia deposit there. The mineralization does keep going down to about 400 meters in some of the domains. But rather than continuing to go deep, we want to be looking for repeats of this along the structure, which is why we're now sort of mapping out and converting these new satellite zones into new JORC resources. and then saying, hey, where can we find the next big one down the main shear? Because we've got about 20 kilometers of untested strike along that shear, which originally hosted a 500,000 ounce deposit and is now pushing on its way closer to 1.5 million ounces. So we've proven the mineralized footprint is much bigger, the endowment is much bigger, and we think we're going to find, repeats of that if we keep doing the right work systematically.
Okay, so putting my sort of that investor hat on, how much longer do you envision? Because I think you've got a scoping study, and by the way, scoping study for those out there, this just means, is it economic? You put numbers around it to have a look at the economics of the project. That's what a scoping study is, yeah.
Yeah, it's basically a first pass. It's the first or most initial pass at determining the potential economics of the project. And then based upon that, you would then advance into a feasibility study where you go down into the next level of detail and you start looking at the specific interplay of key elements and inputs to one another. You start pricing things. You start getting numbers that are more reliable. If you were to say, for example, we push the green button today and go, and you'll see the confidence interval increase or the sort of margin of error decrease once you move from scoping into feasibility studies.
And a scoping study for you guys, am I right in saying there'll be a scoping study starting next year?
Yeah, so we're actually looking at starting a feasibility, or I should say, a preliminary economic analysis or a scoping study for the Tunkillia project. We now have close to 800,000 ounces in the indicated category. So we've got a pretty reasonable body of more confident mineralization to look at putting an initial scoping around. Now, we hope, we anticipate that we will keep growing, but the idea is to establish a baseline understanding of basically how this would look at its core. And conveniently at its core, we've got a higher grade zone there. So we've got a zone that's about 300 meters long with some about 80-meter wide mineralization, but some of that's actually quite high grades with 20 to 30 meters of that. So we've got a good sort of central starting point, and we'll put initial figures on what do we think a moderate or conservative start for this project looks like, and then we'll keep growing it. And then as we advance, we'll turn that into a more full-fledged feasibility and development study.
I haven't touched on Tunkillia yet, but really what I'm trying to fully understand, Alex, is for those people out there, there's lots of different projects, the shareholder value going forward, if you like, what potentially the catalyst might be to create that shareholder value. I said at the beginning, you're a financial economist, so you're very good with numbers. But, people sit there and say, well, what's in it for me? I kind of want you to unpack that in very simplistic terms.
Yeah, look, I think I'd say today we have two responsibilities as an investment team. And I put it that way because, I think we would perceive of ourselves much more as asset managers who happen to be investing and drilling as opposed to just an exploration team. We have a team that has, in our leadership, has got over 200 years of experience exploring for permitting, financing, building, operating, and optimizing major mining assets with a very strong pedigree in gold and a very strong pedigree in South Australia. So we have a sort of a comprehensive skill set that is looking down the track to things like, well, what does a capital return look like for our shareholders?
Yeah.
And so today, what that means is, one, generating value in the ground cost effectively, and we've covered that.
Yeah.
Two, that means preserving maximal ownership of that value in the ground for today's shareholders. So one of the things that we do, I beg your pardon, one of the things that we do and have done during the past 2 years, we're on track to generate about $10 million of additional free cash internally to the company. So we did our IPO 2.5 years ago.
Mm-hmm.
We are on track to generate about $10 million in free cash, which has supplemented our treasury. And we've only done one capital raise in June last year. In fact, after our last resource upgrade, we had several institutions join us and say, look, we'd like to join this story. We see the progressive work. We see the responsive treasury management. The net result there is today, 2.5 years post IPO, the shareholders that we had at IPO still own 94, 95% of the company.
Wow.
And that is unusual, particularly in a down gold market, where equity valuations are down and people are kind of raising capital sequentially to survive. So we are really working very hard, not only spending the money, but also generating, protecting the money. And, so if we then look into the future, if we are able to keep progressing cost efficiently and moving farther and faster than, let's say, an average peer would with the same amount of capital, we can get to an outcome where today's shareholders own more. And then if you're revaluing, the theoretical return is much greater. And then you actually come to the question of, well, returning capital, right? And if we are not servicing hundreds of millions of dollars of surplus debt because we've been able to sort of self-fund or in part self-fund, that means that you can return capital to shareholders faster, which is something that the gold industry, frankly, has been quite bad at doing. And that is one reason why people think, well, gold doesn't pay a yield. Well, a lot of people say, well, gold companies also don't pay a yield. So why am I excited here?
You just got some coverage, I think, from Red Cloud Securities, and I think I'm allowed to say this, that they've initiated coverage and they're talking about, I think it was a 70-cent share price, but your share price today is about 25 cents. That's quite a big gap. Where's the value added coming from that they feel confident about that?
Well, look, I think, momentum is always a key thing when you're looking at these things. And I come from the investment side of the table, looking at resources investments, right? And if you see teams that, regardless of the market circumstances, regardless of the cards they've been dealt, if you find teams that are finding a way and they're continuing to make progress, and importantly, they are doing what they said they're going to do, and they're doing it on time and on budget, that's a team you can sort of say, okay, all else equal, whatever comes to pass, that is a group that's got perhaps the better chance relative to the average of actually getting to an objective. And moreover, in a market where people are generally not doing a lot of new work because capital is so expensive and so hard to come by, I think we've distinguished ourselves, particularly, I mean, in the past 2.5 years since we've become sort of more publicly visible. If you look at our announcements, we have a lot of news flow, and sometimes it feels like we're just sort of constantly saying stuff, but this is not sort of fluffy news flow. This is material, useful news flow, something that's evolving or value add on both the corporate and the project front. And so, we're systematically building that value. We're doing it very efficiently. And I think we're now have painted a very clear picture that, look, these guys bought these assets. They spent kind of a year proving their geological thesis to us. Then they spent a year testing some really key targets. Now we spent the last year growing. We've drilled ahead, and we've got another 8,000 meters of results yet to come in on Tunkillia. So this resource upgrade only included half the drilling there. So we're kind of pushing a potential growth ahead of ourselves. We're pushing a bit of a bow wave into early 2024. And so if we can demonstrate to people, hey, we bought it, we grew it, and we grew it, and we grew it, and we grew it, it sort of gives people that confidence that we've got momentum and we're going in the right direction. And that, I think, is where you get to some of these better valuations. And this all comes back to team. That all comes back to being quite clear in your communications and then actually doing what you say you're going to do. It's amazing how much people value that, right? Which shouldn't be surprising. But it's amazing how little you're often able to do if you're in a down market, which we know, gold equities have been in for nearly 3 years now.
Yeah, but not for too much longer. And we're running out of time, Alex. It's amazing how fast the time goes. Look, we haven't really covered Tunkillia. We'll come back to that next year, I hope. Look, going into 24, just very briefly, what's the news flow, and then just tell us why people should be interested in you right now.
Yeah, so as I mentioned, we have about 8,000 meters of assays still pending from some of our new gold zones at Tunkillia. Yep. So we should, at that, the existing gold zone at Area 51, and also a test of a really interesting geophysical signature at what we call our southeast offset, so just south of the main deposit. So we should be getting both of those sets of assays back kind of the end of January, early February. So hopefully there's some very interesting stuff in there, and hopefully that will also potentially turn into another resource upgrade for Tunkillia during March-ish, which would be 3 in 12 months.
Amazing.
By which time, and I know we won't go to Tunkillia or start Tarcoola, we have the high-grade Tarcoola goldfield. We've just published a 3D structural map for it. So by the time we publish a new resource for Tunkillia, if we're able to do that, we're already going to be drilling some of our favorite targets for shallow, high grade gold, potential new discoveries there, and then hopefully wrapping up the 2024 financial year, 30th of June, with an actual resource on the open pit and potentially some interesting new high grade mineralization on the mining lease. So we've got quite a bit coming. We'll also be selling gold concentrates. We've got about $4 million worth of gold and concentrates. If the gold price runs, it'll be worth more, but we're happy with the four, and we're going to continue to look at how we unlock further value from our assets as well, and keep subsidizing value add growth.
I love it. Subsidizing value added growth is really important. If you were to put a time frame on it, Alex, when would you think maybe you'd get into production? I'm not going to ask you dividends. Too far away.
Yeah, well, look, if we sort of look at that sort of middle distance target of saying, we want to be targeting 150,000 ounces per annum production in, say, 5 years' time, assume you're developing, Tunkillia as our stage 2 expansion in 4 years' time, we'd like to pull forward stage 1 operations if we can generate, the high grade material at Tarcoola that we can put through our existing mill. It'd be really nice to see that happening on a regular steady state production during 2026, maybe starting up even in the end of 2025, if we have high grade mineralization on the mining lease. So we have a pretty clear trajectory to potential accelerated operations and sort of self-sustaining growth. Now we're really sort of leaning into accelerating the definition and delineation of that high grade material.
If people want to find the Red Cloud Securities, I think it's a research paper. Is that on your website?
It is. So we have an investor section on our website, and then sort of one of the bottom sub tabs is research and reports. And so you click on that, and then you just click through a disclaimer. We have three research reports in there, 2 from this year and 1 from 2021.
There you go, ladies and gentlemen. So if you want to go into the deep dive, go onto the Barton Gold website, get those research reports, do your own research. As always, as I always say to you, do your own research. But you know me, I love gold. I think it's time for gold to be shining in the sun. And what I like about Barton Gold, again, not investment advice, but it's the preservation of capital that Alex and his team have been very good at, and managing to not dilute shareholders. But for now, Alex Scanlon, thanks for joining me on Making Money Matter. Or should I say Making Gold Matter?
I think it's both. I think what we're seeing, as we've been discussing, is that gold is once again becoming money. So I think you can play with both those.
There you go. Thanks so much for joining me.
Thank you.